Let's talk about the people who really control the market because if you've been trading for any amount of time, you've felt it. You've felt price do something that looks personal. You've watched it drift toward your stop, like it has your account pulled up on a second monitor. You've watched it spike, take you out by 1 pip, then immediately run to your target like it was showing off. You've seen a clean setup, you enter, and suddenly the market turns into a different animal. And you're sitting there thinking, no way this is random. No way this is just price action. No way the market is just a bunch of candles floating around for fun. So here's the truth, and it's going to calm you down more than it scares you. The market isn't controlled by one evil guy in a chair petting a cat, laughing at your stop loss. It's controlled by incentives. It's controlled by size. It's controlled by order flow. It's controlled by institutions and liquidity providers and large participants who move money for a living, not for dopamine. And the reason this matters is because most retail traders try to trade a market that they don't understand. They trade like price is a fair game, like it's you versus the chart. Like if you just learn enough patterns, you'll finally crack the code. Meanwhile, the market is not a puzzle designed to reward the smartest person. It's a machine designed to facilitate transactions. It exists so big money can move. And the moves you're reacting to are often the byproduct of that process. If you've ever said, the market manipulated me, I'm not going to clown you because I know exactly what you mean. But I'm going to translate it into what's actually happening so you can trade like a professional instead of a victim. Like the video right now, if you've ever been stopped out by a hair and watched price run without you, because that moment is exactly what we're about to decode. Subscribe if you want your brain to stop making up emotional stories about the market and start seeing the structure behind the moves. Share this with the trader who keeps saying they're out to get me, because even if that's not literally true, the pattern behind that feeling is real. Now let's start with the first misunderstanding. Most retail traders think markets move because people are buying and selling randomly based on indicators and news. That's a cute story, but it's not the engine. The engine is liquidity. The engine is where orders are sitting. The engine is where size can execute without causing too much slippage. The engine is where the market can find enough opposing orders to fill big transactions. If you are a retail trader, you can click buy or sell and your order gets filled instantly, and you barely think about it. That's because your size is tiny. You're a speck. You can slip into the market like a ghost. But if you're a bank or a fund or any serious participant trying to move massive size, you can't just smash a button and take the other side like it's a demo account. You need the market to provide enough liquidity. You need enough orders on the other side to fill you. If you buy too aggressively, you move price against yourself. You create your own bad fill. You pay a premium for your impatience. That's not how professionals operate. So what do? They execute in a way that seeks liquidity. They look for places where orders are clustered. They look for areas where stops are sitting because stops are orders. They look for areas where breakout traders are waiting because breakout entries are orders. They look for areas where people are trapped because trapped traders create forced exits and forced exits create liquidity. This is why you see those violent spikes. This is why you see price run above a high and slam back down. This is why you see it sweep a low and reverse. This is why you see it fake out right before the real move. It's not always some cartoon villain. It's the market doing what it has to do to facilitate bigger transactions. It's the path of least resistance to fill orders. Now here's where people get emotional. Retail traders personalize it. They think the market is hunting me. What's really happening is the market is going where orders are. And to a retail trader, your stop just happens to be sitting in the same place as 1,000 other stops. That's why it feels personal, because you're standing in the same crowd. If the crowd is standing on railroad tracks and the train comes through, it's not because the train hates you. It's because you were in the obvious place. That's the first power behind price moves. Obviousness is expensive. If you want to succeed, you'll have to stop placing yourself in obvious areas where everyone else is positioned the same way. The market doesn't reward common sense the way you think it does. Common sense is where liquidity lives. Common sense is where the crowd is. Common sense is where stops pile up. I remember a phase where I would set my stop like I was copying a textbook. Swing low, swing high, just beneath support, just above resistance. I felt clean. I felt technical. I felt like I was doing proper trading. And over, I would get wicked out. 1 pip, 2 pips. Then price would go exactly where I originally expected. And at first, I thought my analysis was wrong. Then I realized my analysis was right, but my placement was predictable. My stop was sitting exactly where a million other traders learned to put it. So I started doing something different. I stopped asking, where would a stop loss make sense? I started asking, where would the crowd put it? I started asking, where would price have to go to create pain? Because pain creates liquidity, and right there, that's the mental shift. You're not just reading candles, you're reading incentives. You're reading who is trapped, who is early, who is late, who is emotional, who is forced to act. There's always someone in the Discord, or in the group chat, or in the comments who's constantly saying, this is manipulation. Every loss, manipulation. Every wick, manipulation. Every stop out, manipulation. And that trader stays stuck because the label becomes a crutch. It becomes a way to avoid taking responsibility for their process. It becomes a way to avoid upgrading their understanding. But here's the funny part. If that trader could just zoom out emotionally for 5 minutes, they'd realize the market is not cheating. The market is doing what it's designed to do. It's searching for liquidity. It's moving to places that attract participation. It's flushing weak hands. It's rewarding patience and punishing predictable behavior. So the real question isn't who controls the market. The real question is, how do markets actually move? Markets move when there is an imbalance between buying and selling pressure, and that imbalance often starts with a liquidity event. A stop run, a breakout trigger, a news release, a big option level, a rebalancing flow, a hedging flow, a large participant needing to get filled. It's not always one thing, but the pattern is the same. There's a reason price accelerates. It's not magic. Now let's talk about the phrase smart money. People throw it around like it's a secret society. Smart money is not a group chat. Smart money is just money that has to operate differently because it's large. It can't be impulsive. It can't be emotional. It can't just chase. It must execute with intention. It often uses liquidity the same way you use a door handle. You don't kick a wall to get into a building. You look for the door. Liquidity is the door. That's why price often moves toward highs and lows. Those are doors. They attract orders. They attract attention. They trigger breakout traders. They sit near stops. They become magnets. So when you see price drifting toward a major high, it's not always because it wants to break out. It's because there's liquidity there. There are orders there. There is participation there. There is fuel there. Big players don't always want to buy at the high and sell at the low like retail does. They often want to buy into panic and sell into euphoria. They want to enter when liquidity is available, and liquidity is most available when retail is emotional. Retail provides liquidity by doing the most predictable human things. Chasing breakouts late, putting stops in the same obvious spots, closing losers at the worst moment, closing winners too early because of fear, doubling down because of ego. Those behaviors create the flows that bigger participants can use. So what do they want from you? They want you predictable. They want you to chase when you're excited. They want you to cut when you're scared. They want you to place stops where everyone else places stops. They want you to become liquidity at the worst time because your behavior creates their opportunity. Now, if you're listening and you feel that sting, don't get mad. Get sharper. The market doesn't care how you feel. It pays you for understanding. Comment. I've been the liquidity if you've ever realized you were consistently getting shaken out before the real move. Not because I need the comment, because admitting it out loud breaks the victim mindset and puts you back in control. Now let's talk about news, because this is where people really get confused. You'll watch price move aggressively and the news hasn't dropped yet. Then the news drops and it looks like the market already knew. Then retail says, insiders. Sometimes, sure, information leaks exist in the world, but a lot of the time it's simpler than that. Markets are forward-looking. Big participants reposition before events. They hedge. They reduce exposure. They accumulate. They distribute. They manage risk around expectations. Price doesn't wait for your headline to move. The headline is often the story that gets attached after the move is already happening. That's why you can't trade news like a retail tourist and expect to win. You see a headline and think you're early. You're not early. You're late. You're reacting. The market already positioned. So the real power behind price moves is not the headline, it's the positioning, it's the flow. This is also why indicator trading breaks people's brains. Indicators are derived from price. They are not the cause of price, they are the echo. If you only trade the echo, you will always be late. Price moves because orders hit the market. Price moves because liquidity gets taken. Price moves because participants reposition. Price moves because risk gets transferred. The indicator is just the shadow. You might think succeeding means predicting. You might think succeeding means being right. That's the retail ego trap. Professionals don't need to be right all the time. They need to manage risk and catch the distributions that matter. If you want to trade like someone who understands power, you stop trying to predict every wiggle. You start trying to align with the flows that create the bigger moves. You start waiting for liquidity grabs. You start watching how price reacts after it takes a high or a low. You start noticing when a breakout has no follow-through. You start noticing when price accelerates away from a level like it just found fuel. This is where your chart stops looking like random candles and starts looking like behavior. And behavior is always about incentives. So when I say the people who control the market, I'm not saying there's one wizard. I'm saying there are participants with enough size that their needs shape the path price takes. I'm saying liquidity providers and institutions and market makers and large funds operate in a way that creates patterns you can learn. The control is structural, not personal. And once you accept that, you stop getting offended by stop runs. You start respecting them. You start using them. Because here's the reality. Stop runs can be entries. They can be the moment liquidity is grabbed and the real move begins. That wick you hate might be the signal that the market just collected the orders it needed. If you're still with me, like the video because you're moving from retail thinking to professional thinking. Subscribe because this is the kind of understanding that changes everything. Share it because most traders never hear this and it would save them years. Chapter 2. Now let's go deeper because if we stop at liquidity and institutions, you'll leave with the vibe but not the precision. You need to know what these players actually are, what roles they play, and why their job creates the moves you keep calling manipulation. So let's name the real power structures without turning this into conspiracy theater. In most major markets, you have different types of participants. You have liquidity providers and market makers whose job is to quote prices and facilitate trades. You have banks and dealers moving flow for clients. You have hedge funds and asset managers deploying capital based on strategies, rebalancing, and macro views. You have algorithmic participants executing systematically. You have corporations hedging currency exposure. You have retail traders, small prop firms, and everyone else trying to carve out a piece. Not all of these participants are controlling price in the same way. Some are responding, some are providing liquidity, some are consuming it, some are hedging. But here's what matters. The bigger the participant, the more their execution influences the path price takes. Think about it like this. If you drop a pebble into a pond, you get tiny ripples. If you drop a boulder, you change the whole surface. Retail is pebbles. Institutions are boulders. Your chart is the surface, so when you see price move like it got possessed, you're usually seeing a boulder event. Either big orders hit, liquidity got vacuumed, or a cascade of stops and triggers got activated. The market moves fast when orders stack in the same direction. This is why price doesn't move smoothly. It moves in bursts. It moves in expansions and contractions. It moves like it's breathing. Accumulation, expansion, distribution, another accumulation, another expansion. The retail brain wants a straight line. The market doesn't owe you a straight line. Now let's talk about the most misunderstood creature in the market maker or liquidity provider. Their job is not to predict direction. Their job is to provide a two-sided quote, manage inventory, and earn through spreads, rebates, and execution. They aim to stay neutral or manage risk in a way that doesn't expose them to massive directional damage. That means they care deeply about flow, about where stops are, about volatility, about where liquidity sits, and about how to hedge. That's why certain levels act like magnets. Because those levels concentrate orders, and concentrated orders create opportunities for execution and hedging. Retail traders often place stops in the most obvious places, under the last low, under support, above resistance, above the swing high. Those are logical places for a textbook, but they're predictable. When price approaches those areas, the market often becomes more liquid because stops are resting orders. When those stops trigger, they become market orders. Market orders are aggressive. Aggressive orders move price, so once stops get triggered, price can accelerate. That acceleration can be used by larger participants to enter or exit. So is the market hunting stops, not in the sense of an evil plan against you personally, but in the sense that price will often move into liquidity pockets because that's where business can get done. If you're a big buyer, you want sellers. Where do sellers exist? Under lows when stops trigger and breakout sellers jump in. If you're a big seller, you want buyers. Where do buyers exist? Above highs when stops trigger and breakout buyers jump in. So, yes, price often runs highs and lows. That's not mysticism, that's mechanics. Now, let's address the most dangerous belief retail traders carry. They think they can outsmart the market by being clever. They think if they just find a secret indicator or a hidden pattern, they'll beat the system. The truth is, you don't beat the market by being clever. You beat the market by being aligned. Aligned with what? Aligned with the structure of liquidity and the timing of participation. You don't want to fight the biggest players. You want to understand how they operate and stop positioning yourself as easy liquidity. You wake up, you check your chart, and you see price approaching a big level. You get excited. You tell yourself, if it breaks this level, it's going to fly. So you enter early because you want a better price. Price dips a little and you feel uncomfortable, so you move your stop tighter because you don't want to be wrong. Then price spikes down, takes you out, and now you're angry. Then it turns and runs, you chase. Now you enter late, then it pulls back. You panic, you close. Then it runs again. That cycle is not about your strategy. That cycle is you being pulled by the same emotional strings that the market constantly exploits. Impatience, fear, ego, and the need for certainty. The market doesn't need to know you. It just needs to know what humans do. And humans are predictable. So what do they want from you? They want you to be emotionally predictable. They want you to chase. They want you to tighten stops at the worst moment. They want you to enter late. They want you to exit early. They want you to be impatient. They want you to trade because you're bored. If you remove those behaviors, the market suddenly feels less personal. It feels less like it's attacking you because you're no longer standing where the crowd stands. Now let's talk about a big reason price makes those violent moves that feel like betrayal. Leverage. Modern markets have tons of leveraged participants. That means when price moves, people are forced to act. Forced liquidation, forced margin calls, forced hedging, forced stop-outs, forced rebalancing. Those forced actions are fuel, so sometimes price isn't manipulated as much as it is cascading. One level breaks, it triggers stops, triggers breakouts, triggers hedges, triggers liquidations, and now you have a chain reaction. The market doesn't need a mastermind for that. It just needs a crowd positioned the same way. This is why positioning matters. This is why a lot of the secrets are just this. The market punishes crowds. If you're enjoying this, share it with someone who still thinks the market is random. Not because you want to win an argument, because once you see the mechanics, trading becomes calmer. Now I'm going to give you a key concept that will change your chart reading without turning into a checklist. The concept is this. Price is not trying to move. Price is trying to fill. When you stop seeing price as a thing that moves and start seeing it as a thing that fills orders, everything changes. You stop asking, where is price going? You start asking, where is liquidity? Where are orders likely sitting? Where are people trapped? Where would forced buying happen? Where would forced selling happen? That's how you start reading power. Because power is not who has the loudest opinion. Power is who has to execute size. Now let's take a step into the part that confuses people the most. Why does price often reverse right after it breaks a level? Because the break was often the liquidity event, not the start of the trend. The break triggers breakout traders and stops. That creates a surge of market orders. That surge is liquidity for someone on the other side. If a big player wanted to sell, that breakout buying is their perfect exit liquidity. If they wanted to buy, that breakdown selling is their perfect entry liquidity. So the crowd sees confirmation. The professional sees fuel. That's why the market loves to give you a candle that looks like confirmation and then punish you. It's not personal, it's structural. Now I want you to understand something important so you don't take this video and become paranoid. Not every wick is manipulation. Not every stop out is a hunt. Sometimes you just placed a bad trade. Sometimes the market is volatile. Sometimes your timing is off. Sometimes the higher time frame is against you. Sometimes liquidity is thin. Sometimes you entered in the middle of noise. A serious trader doesn't blame. A serious trader studies. So instead of leaving this video thinking the market is rigged, I want you leaving thinking the market has mechanics. Mechanics can be learned. Mechanics can be used. Mechanics can be respected. And if you respect them, you stop being food. Like the video because you're choosing understanding over coping stories. Subscribe because we're going to keep building this lens until your chart starts looking obvious. And comment if you've had that moment where you realized your stop placement wasn't bad, it was just predictable. That awareness is step 1. Chapter 3. Now we're going to talk about what really makes this whole thing feel like a movie. The timing, because if you've ever watched price do something insane right at the same time every day, you're not crazy. There's structure to when the market becomes dangerous, and there's structure to when the market becomes honest. Most retail traders approach the market like it's one continuous thing. Like price is just moving through the day with the same behavior. That's not how it works. The market has personality changes. It has mood swings. It has different hours. It behaves differently when liquidity is high versus when liquidity is thin. It behaves differently when the big players are active versus when it's mostly retail noise. This is a major part of the power behind price moves. Because if you don't understand timing, you can have the right idea and still lose repeatedly just because you're stepping onto the freeway at the wrong time. Let's put it into real-life language. There are times during the day when the market is like a crowded mall. Everybody's there, everybody's shopping, there's enough people to absorb movement, and price can flow in a more controlled way. Then there are times during the day when the market is like an empty street at 3 a.m. One car drives by and it sounds loud. One order hits and it can shove price further than it should. That's where you get those random spikes. That's where your stop gets clipped for no reason. That's where you feel targeted. So a big secret is this: not all price moves are equal. A move during thin liquidity is not the same as a move during deep liquidity. The same candle can mean two completely different things depending on when it happens. The market isn't only about where, it's also about when. Retail traders mostly obsess over levels. Levels matter, but timing is the multiplier. If you trade the right level at the wrong time, it becomes a trap. If you trade the right level at the right time, it becomes a weapon. So let's talk about sessions because this is where the control becomes obvious. In Forex and indices, you have the Asian session, London session, and New York session. Different liquidity profiles, different participants, different agendas, different flows. Even in crypto, which is 24/7, you can still see session-based behavior because big money is still human, still institutional, still working within time zones, still responding to US market hours. One of the biggest reasons retail gets crushed is they don't understand that price is often setting traps before a session opens. Price loves to set the stage. Price loves to create false confidence. Price loves to lure the crowd into the wrong side, so the real move has fuel. So if you've ever wondered why the market moves clean in 1 hour and then turns demonic in another, it's not demons, it's participants. There was a phase where I used to trade anytime I had free time. If I woke up and the chart looked like it was moving, I traded. If it was late at night and I was bored, I traded. If I was on my phone and I saw a candle spike, I traded. And what I noticed over and over is I would get chopped up. I would get wicked out. I would get fake moves. Then I started focusing on one specific window. I stopped trading when liquidity was thin. I stopped trading when the market was just drifting. I started showing up when there was a reason for movement. And suddenly, it felt like the market changed. It didn't change. I changed. I stopped trying to trade randomness. That's a huge secret. Most people are trying to trade noise and calling it bad luck. Now let's talk about what big players actually do around session opens. This is where you need to stop thinking of them like random buyers and sellers and start thinking of them like operators. Large participants often build positions over time. They accumulate, they distribute, they need liquidity. They may run price into areas where stops are sitting, trigger a wave of market orders, then use that liquidity to fill their real position. The crowd sees a breakout. The crowd sees excitement. The operator sees inventory. This is why price can look like it's breaking out in London and then reverse in New York. It's not because the market is bipolar. It's because London and New York participants aren't the same. The flows aren't the same. The agenda isn't the same. Sometimes London creates the move. Sometimes London creates the trap for New York. Sometimes New York creates the real continuation. Sometimes New York creates the reversal. You can't trade this game like a tourist. You need context. The market is not a chart. The market is a battlefield for liquidity, and the levels you're watching are basically territories. When price approaches a major level, it's not just support or resistance. It's an area where a lot of orders exist. It's where different groups are positioned and waiting. It's where stops exist. It's where breakouts exist. It's where limit orders exist. It's where hedges exist. It's where people have emotional attachment. So what happens around those territories? There's a fight. And that fight often involves deception, because deception creates predictable behavior. If you can make the crowd believe one thing, you can move them into a position that benefits the other side. If you can get retail traders convinced a breakout is real, they'll pile in late. They'll add liquidity. They'll create the fuel, then you can reverse. If you can convince them a breakdown is real, they'll panic sell into the low. Then you can buy into their fear. That's the real power. Not because the market is evil, but because markets are competitive. And in competitive environments, the predictable lose and the prepared win. You'll watch price start moving 20 minutes before the news. Sometimes an hour, sometimes the entire day. Then the news drops and it just continues or reverses violently. Retail says the market knew. Retail says insiders. Retail says manipulation. And again, sometimes there are information advantages. That's real. But the bigger picture is about positioning and expectation. Institutions don't wait for headlines. They move based on probabilities. They move based on forecasts. They move based on positioning in futures markets, options markets, and macro expectations. They hedge. They reduce risk. They increase risk. They anticipate. They reprice. So by the time the news hits your screen, the market is already deep into the narrative. The actual release becomes the trigger for volatility, not the origin of direction. This is why price sometimes spikes both ways on news. It's not because the market is confused, it's because liquidity thins out, spreads widen, stops cascade, algos fire, and everyone tries to reposition at once. That chaos is a liquidity event. A smart trader doesn't try to predict the news candle. A smart trader waits for the market to reveal what it's doing after the liquidity shock. There's a trader named Jay. Jay thinks he's smart. Jay thinks he can trade news. Jay watches the calendar, waits for CPI or NFP, and he has a plan. As soon as the number comes out, he clicks buy or sell, depending on whether it's higher or lower than expected. Jay thinks he's trading fundamentals. In reality, Jay is trading speed. Jay gets slipped, Jay gets wicked, Jay gets filled at the worst price. Jay watches price spike, reverse, spike again, then settle. By the time it actually trends, Jay is already stopped out twice and emotionally damaged. Then Jay says, "Bro, the market is rigged." Jay didn't get rigged. Jay brought a knife to a gunfight. Institutions don't trade news like that. They position, they hedge. They use options, they use size management. They may even use volatility itself as the product. Retail tries to gamble the candle. So, yes, the power behind price moves includes news, but not in the way retail thinks. Retail traders are often trading the middle. They enter in the middle of ranges. They enter in the middle of sessions. They enter in the middle of the narrative. They enter because they see a candle and feel like they need to participate. Professionals often operate at extremes. They accumulate at discounts. They distribute at premiums. They execute around liquidity pools. They use the crowd's emotions to fill their orders. So if you want to stop being the one who gets cooked, you need to stop entering where you feel safe and start entering where the market feels scary. That doesn't mean you become reckless. It means you wait for liquidity events and reaction. You wait for the market to show its hand. Because here's the secret. The market reveals itself after it grabs liquidity. When price runs a high, runs a low, grabs stops, breaks structure, triggers excitement, what happens next matters more than the grab itself. Does price continue with strength? Does it snap back immediately? Does it stall? Does it reaccumulate? Does it reclaim levels? Does it fail? That reaction is where you see the power. Most retail traders get trapped because they enter on the grab. They enter at the moment everyone is emotional. Professionals often wait for the grab and then trade the reaction. That one change alone can save you from half your losses. If you keep buying highs because you're scared of missing out, you will keep being exit liquidity. If you keep selling lows because you're scared of losing money, you will keep being entry liquidity. The market doesn't need your money to move. It needs your predictability to make moving easier. And the crowd is predictable. Now, a lot of people hearing this become paranoid. They start seeing manipulation everywhere. They start thinking every candle is an attack. That's not the goal. The goal is the opposite. Calm. The more you understand these mechanics, the less emotional you become. You stop being shocked by stop runs. You expect them. You stop being offended by fake outs. You respect them. You stop being surprised when price returns to a level. You know why it happened. Understanding creates calm. Calm creates patience. Patience creates better entries. Better entries create consistency. So what do they want from you? They want you to be impatient. Because impatience makes you enter at the wrong time. Impatience makes you trade the middle. Impatience makes you chase. Impatience makes you break rules. If you master patience, you remove your biggest weakness. Imagine price as a crowd of people moving through a hallway. The hallway is liquidity. The doors are highs and lows. The crowd moves toward doors because doors are exits and entrances. When the crowd reaches a door, it compresses. It gets emotional. It gets chaotic. That's where people push. That's where people get trapped. A smart trader doesn't jump into the crowd during the shove. A smart trader waits to see which side wins and then follows the flow with risk control. That's how you trade power. Now let's build this into a practical mindset without turning into a step list. Because you're not going to succeed from a list. You're going to succeed from lens. Your new lens is this. Price moves to liquidity. Liquidity creates fills. Fills create imbalances. Imbalances create trends. Trends create exit liquidity. Exit liquidity creates reversals or continuations. And the participants with size exploit this structure not by being evil, but by being efficient. If this chapter is giving you clarity like the video because you're training your brain to see the market as a mechanism, not a mystery. Subscribe because the deeper we go, the less random trading feels. Share this with someone who keeps thinking the market is out to get them, because it might save them years of frustration. Chapter 4. Now we're going to talk about the most dangerous illusion in trading. The illusion that the market is just lines and patterns. Because once you start understanding who really controls price, the temptation is to become obsessed with smart money concepts and think the secret is hidden inside some complicated model. It's not. The real secret isn't hidden. It's right in front of you. It's the behavior of crowds. It's the way human beings respond to risk, pain, and uncertainty. And the people who control the market don't need mind-reading powers. They just need to understand how the crowd behaves, because the crowd is predictable. This is where the conversation gets real because this is the part that explains why the market feels like it has a personality, why it feels like it's teasing you, why it feels like it's humiliating you in public. That feeling comes from a simple truth. The market is designed to find the most efficient price to facilitate transactions, and the most efficient path is often the one that forces the most people to do the most emotional thing at the worst possible time. That's how it collects liquidity. So let's talk about levels, because levels are where most retail traders build their entire identity. Support and resistance, breakouts, trend lines, fib levels, supply and demand zones, order blocks, whatever you want to call it. Levels matter, but not because they're magical lines. Levels matter because they represent mass agreement. They represent areas where many people are committed, emotionally and financially. Think about that. A level is not just a price. It's a belief. It's a belief that this area matters. It's a belief that this is where buyers will step in. It's a belief that this is where sellers will defend. It's a belief that if it breaks, it will run. And when enough people believe in something, their orders stack in predictable places. That's what creates liquidity. That's what creates traps. So the reason the market loves to return to certain levels isn't because of some cosmic memory. It's because orders remain there. It's because unfinished business exists there. It's because participants still have inventory there. It's because people are still emotionally anchored to that area. This is also why you'll see price come back to a level days later and react again. Retail thinks it's a miracle. Professionals know it's normal. Liquidity doesn't disappear just because you stopped looking at the chart. Retail traders assume a level is either support or resistance, and they treat it like a wall. But the market doesn't treat it like a wall. The market treats it like a zone of negotiation. Inside that negotiation is where orders get filled. Inside that negotiation is where the crowd gets confused. Inside that negotiation is where traps happen. So a retail trader sees price approach resistance and thinks, it's going to reject, let me short. Or they see it break resistance and think, it's going to run, let me buy. Either way, retail wants simplicity. They want a binary outcome, up or down, break or bounce, win or lose. Big money loves that simplicity because it creates predictable order placement. So what happens? Price runs the level, it triggers breakouts, it triggers stops. It creates a surge of market orders. That surge provides liquidity. Then the real move starts. And that's why you get the classic experience. The breakout you took failed. The breakdown you took failed. The reversal you took failed. Then the market did the move without you. It's not because you're cursed, it's because you're entering during the negotiation instead of after the decision. Now here's the key. The decision often happens after liquidity is grabbed. Let's slow it down and make it obvious. Imagine a range. Price has been trapped between a high and a low. Retail traders are bored. They keep buying the bottom and selling the top, thinking they're smart. Breakout traders are waiting above the high and below the low. Stops are clustered outside both sides. Everyone thinks they know what happens next. What does the market do? It goes to one side first. It grabs liquidity. It triggers stops. It triggers breakouts. It creates emotional commitment. Then it moves to the other side. That's why range breakouts destroy people. Because ranges are liquidity containers. Ranges are not consolidation. They are accumulation zones for orders. They are collection zones. They are traps waiting to activate. So if you are the trader who keeps getting cooked in ranges, it's because you are trading inside the collection box without understanding what it is. There was a time where I was obsessed with entries. I wanted the perfect entry. I wanted to catch it at the exact moment. I wanted to feel like a sniper. I wanted to feel like I was smarter than everyone else. And what happened is I became impatient. I started entering too early. I started anticipating instead of confirming. I started getting chopped up. I started losing over and over in the same areas. And every loss felt personal because my ego was involved. I didn't just lose money. I lost the feeling of being sharp. Then something clicked. I realized the market is not going to reward my ego. The market rewards patience. The market rewards timing. The market rewards letting the crowd commit first, then following the real flow. So I changed my approach. I stopped trying to be early. I stopped trying to be the first person to enter. I started waiting for liquidity grabs. I started waiting for price to show rejection or reclaim. I started waiting for structure shift. And my results changed, not because I became smarter, but because I stopped being addicted to the feeling of being right first. That is a major secret of success. Most traders fail because they are addicted to being early. There's a trader named Chris. Chris is in a community. Chris watches YouTube all day. Chris is always learning the next concept. One week it's supply and demand. The next week it's order blocks. The next week it's fair value gaps. The next week it's liquidity. Chris thinks the missing piece is always the next concept. But Chris is still losing. Why? Because Chris is not missing concepts. Chris is missing discipline and timing. Chris keeps trying to predict the market instead of letting the market show itself. Chris enters because he feels like he knows. Then price runs the other direction, grabs liquidity, and now Chris is trapped. Now Chris is emotional. Now Chris is adding to losers. Now Chris is closing winners early. Chris calls it manipulation, but the truth is simpler. Chris is predictable. Chris is doing what crowds do. Chris is trading beliefs instead of behavior. And the market loves traders like Chris because they provide liquidity and they provide fuel. Now, I want to talk about the psychology of why this feels like power. The market controls you through uncertainty. Uncertainty creates discomfort. Discomfort creates action. Action creates mistakes. That's the whole loop. If you are uncomfortable watching price fluctuate, you will do something. You will move your stop. You will close early. You will add to the position. You will hedge randomly. You will jump to another pair. You will take another trade. You will do something. And that something is usually the exact thing that kills your edge. This is why discipline is actually emotional strength. Discipline is the ability to sit inside uncertainty without reacting like a child. So when we say the people who control the market, part of it is structural and part of it is psychological. Because the market doesn't just move price, it moves minds. It turns confident people into impulsive people. It turns patient people into gamblers. It turns calm people into angry people. It turns disciplined people into reckless people. And if you don't realize that, you'll keep thinking the battle is on the chart when the battle is in your nervous system. Now let's talk about what they want from you at the psychological level. They want you to need certainty. Because if you need certainty, you will enter too late. You will wait for confirmation. You will wait for the move to already happen. Then you will chase. And chasing is the easiest way to become liquidity. They want you to fear losses. Because if you fear losses, you will tighten stops. You will get stopped out more. You will lose trust. You will start revenge trading. You will spiral. They want you to be impatient. Because impatience makes you overtrade. It makes you take low-quality setups. It makes you break your rules. They want you emotional. Because emotional traders provide liquidity at the worst times, they buy highs, they sell lows, they chase breakouts that are about to reverse, they panic out of positions that are about to run. So the real power behind price moves is not just money. It's the ability to use crowd psychology to create liquidity. This is why markets are beautiful but brutal. They are not moral. They are not fair. They are not unfair. They are just efficient. Now let's go deeper into the idea of building positions, because that's what retail traders struggle to understand. They think big money just buys and sells. In reality, big money builds. Building a position means they enter in pieces. They accumulate over time. They use price moves to get better average prices. They may even push price against their desired direction temporarily to collect liquidity. So imagine a big buyer wants to buy. They need sellers. Sellers appear when price drops and retail panics, stops trigger, and breakdown traders sell. So price may drop to create sellers. The big buyer absorbs. Then once inventory is accumulated, price can rise. That drop feels like manipulation to the retail buyer who entered too early. But for the big buyer, it was just collecting. Same thing on the sell side. A big seller wants buyers. Buyers appear when price breaks highs, triggers stop losses for shorts, triggers breakout buys, and creates excitement. So price pushes up, collects buyers, distributes into them, then drops. That pump feels like manipulation to the retail seller who shorted too early. But for the big seller, it was just distributing. Once you see that, you stop getting emotionally violated by wicks. You start seeing them as business. Now let's talk about the hidden engine behind a lot of this. Liquidity providers and algorithms. Modern markets are heavily algorithmic. That doesn't mean every move is a robot conspiracy. It means execution is optimized. It means many orders are executed by algos designed to minimize impact, find liquidity, and reduce cost. Algorithms love predictable human behavior because it's easy to exploit. If retail traders consistently place stops under obvious lows, the algorithm knows where liquidity sits. If breakout traders consistently chase after confirmation, the algorithm knows how to trigger them. So the market becomes this machine where human predictability becomes a resource. You are not trading against someone's intelligence, you are trading against the machine's efficiency. That's why the traders who win are the ones who stop being predictable. They don't chase, they wait. They don't trade boredom, they trade intention. They don't need certainty, they accept probability. They don't worship levels, they watch behavior at levels. If you want to succeed, you need to become someone who doesn't donate liquidity. You should stop focusing on the idea of catching moves. You should start focusing on the idea of avoiding traps, because you don't need to catch every move to win. You need to avoid the moves that exist to take you out. Most retail traders lose because they enter in trap zones. They enter before liquidity is collected. They enter because they saw something. They enter because they felt something. They enter because they don't want to miss. And that's exactly what the market wants. If you're still with me, like the video because you're realizing the enemy isn't the market, it's predictability. Subscribe because this lens is going to change how you see every chart forever. Share this with someone who keeps thinking they need a new indicator, because what they really need is a new perspective. Chapter 5. Now we bring it all together because knowledge without application is just another form of entertainment. And I don't want you walking away from this video feeling like you learned something cool, then going right back to the same mistakes with a new vocabulary. This isn't about turning you into the guy who comments liquidity grab under every chart like he's in a secret society. This is about turning you into the trader who finally understands what's happening, so your decisions stop being emotional. Because that's the real enemy. Not the market, not institutions, not manipulation. The real enemy is you reacting to a system you don't understand. So if we had to sum up the entire truth of this video in one simple sentence, it would be this. Price moves to where orders are. That's it. That's the core. Price is not moving because your RSI crossed. Price is not moving because your moving average turned blue. Price is not moving because you drew a trend line and prayed. Price is moving because participants need to execute size and they need liquidity to do it. So the market is constantly hunting for places where liquidity exists. The crowd provides liquidity through predictable behavior. That's what they want from you. They want you to behave like the crowd. They want you to trade in obvious areas. They want you to chase confirmation. They want you to put stops where everyone puts stops. They want you to panic at extremes. They want you to overtrade when you're bored. They want you to revenge trade when you're hurt. They want you to think the market is a puzzle and your job is to solve it, instead of realizing the market is a machine and your job is to operate inside it intelligently. So if you're asking yourself, okay, how do I actually win with this information? Here's the answer. You win by becoming less predictable. You win by trading after the trap, not during it. You win by waiting for liquidity grabs and then trading the reaction. You win by respecting timing and context, not just levels. You win by controlling risk so you can stay calm enough to execute like a professional. You win by training patience like it's a weapon. Now, I'm going to walk you through what this actually looks like in real life, in real trading, without turning this into a robotic checklist. Because you're not a robot, you're a human being. And you need principles that you can apply across different market conditions. The first principle is this: stop believing the first move. The first move is often the bait. The first move is often the liquidity grab. The first move is often what triggers the crowd. The first move is often what creates forced buying or forced selling. So instead of chasing the first move, you watch it. You let it reveal itself. You let the crowd commit first. That's how professionals think. They don't chase. They observe. They wait for the market to show its hand. They let the market create the liquidity event, then they look for confirmation through reaction, not through indicators. Because the reaction tells you if the move was real or if it was just collecting. Let's make this feel real. You see price breaking a high. Retail traders immediately think, breakout. They buy. Shorts get stopped. Momentum traders pile in. Everyone feels confident. The candle looks strong. The smart trader asks a different question. What happens next? Does price continue with strength, holding the level and building above it? Or does it immediately snap back below and fail? Does it reject, reclaim, and then run? Does it create imbalance and not look back? Or does it stall and drift? That reaction is the difference between continuation and trap. Most retail traders don't wait for reaction because waiting feels like missing out. But waiting is what saves you. Waiting is what stops you from becoming the liquidity. So the first principle is stop believing the first move. The second principle is this: stop placing yourself in obvious pain points. This is the part people hate because they want comfort. They want simplicity. They want to feel safe. But the market doesn't reward comfort. It rewards insight. If your stop is always under the most obvious low, you will keep getting clipped. If your entry is always after the most obvious confirmation candle, you will keep entering late. If you always sell the break of a low after the market already ran down, you will keep selling at the bottom. If you always buy after price already ran up, you will keep buying at the top. So you need to evolve. You start thinking in terms of liquidity pools, not support and resistance. Where is the crowd's stop placement? Where are breakout traders likely waiting? Where are people trapped? Where is the pain? Because pain creates forced orders. Forced orders create liquidity. This doesn't mean you become paranoid. It means you become strategic. Now, let's talk about the third principle, and this is what separates the traders who just get the concept from the traders who get paid. You don't trade the story, you trade the structure. A lot of retail traders become obsessed with market narratives. Who's manipulating? Who's controlling? The banks, the hedge funds, the institutions. That obsession becomes another emotional attachment. But structure doesn't care about your narrative. Structure is what price is doing, not what you think it should do. So you stop turning the market into a personal enemy. You stop treating losses like disrespect. You stop trying to get revenge on the chart. You start treating the market like weather. Some days it rains, some days it's sunny, some days it's windy. You don't take it personally, you adapt. Professional traders aren't emotional warriors, they're operators. They show up, run the system, manage risk, and leave. That's how you become consistent. Now, I want to give you a viewer call out because this part matters. If you are the trader who constantly feels like the market is against you, you are emotionally attached, you are trading with ego, you are trading like you need to prove something, and that will always make you predictable. The market doesn't beat you with magic. It beats you through your emotions, so if you want to stop losing, stop reacting. Now let's talk about how to actually use liquidity grabs the right way. Most traders either ignore liquidity concepts entirely, or they become obsessed and start labeling everything. Both extremes lose. The real trader uses liquidity as context. If price runs a high, grabs liquidity, and then returns below that high, that tells you the breakout was used as fuel. That tells you buyers were lured in and then trapped. That tells you there may be selling pressure or distribution. If price runs a low, grabs liquidity, and then reclaims that low quickly, that tells you the breakdown was used as fuel. That tells you sellers panicked and got trapped. That tells you there may be buying pressure or accumulation. Now, the key is not just identifying the grab, it's the speed and quality of the reclaim. If price snaps back aggressively, it's often a stronger signal than if it slowly drifts. That speed is power. That speed is urgency. That speed tells you who is in control. And this is how you stop being the victim. Instead of placing your stop where everyone places it, you start positioning based on where the trap would fail. Instead of entering on the breakout, you enter on the reclaim. Instead of chasing the first move, you trade the reaction. And once you start doing this consistently, the market starts feeling less like chaos and more like a system. When I stopped trying to trade everything and started waiting for high probability moments, my stress dropped. My overtrading dropped. My emotional spikes dropped. I didn't feel like I had to be in the market constantly to be a trader. I realized something important. You don't get paid for being active. You get paid for being right at the right time with controlled risk. That's it. Most retail traders think more trades equals more money. In reality, more trades often equals more mistakes. More trades often equals more exposure to randomness. More trades often equals more emotion. And emotion is the tax you pay for impatience. So I started trading less, waiting more, and my results improved. That's not an opinion. That's what happens when you stop being liquidity and start being selective. There's a trader named Eric. Eric has been trading for 2 years. Eric knows a lot. Eric can talk. Eric can chart. Eric can explain. Eric is still losing. Eric thinks he needs a new strategy. But Eric's real problem is that he trades like he's chasing certainty. He trades like he needs to be right now. He trades like every day must be profitable. He trades like a man under pressure. So Eric keeps entering late. Eric keeps placing stops tight. Eric keeps moving stops. Eric keeps taking profits early. Eric keeps revenge trading. And the market keeps punishing him. Not because the market hates him, but because he is predictable. Now imagine Eric learns this concept. He learns that the market moves to liquidity. He learns that stop runs aren't personal, they're structural. At first, he gets excited. He thinks he found the secret, but nothing changes. Why? Because he didn't change his behavior. So here's the final truth. Understanding the market is not enough. You must also become the trader who can execute the understanding. That means emotional control. That means patience. That means rules. That means risk management. That means being able to sit still when nothing is happening. That means being able to take a loss and not spiral. That means being able to watch price move without chasing it. Because if you can't do those things, you will still lose, even if you know the secrets. The market is controlled by size. It's controlled by incentives. It's controlled by liquidity. The market does not care about your feelings. It does not care about your rent. It does not care about your dreams. It will not reward your hope. It will only reward your understanding and your execution. So if you want to win, you have to stop being emotional currency in someone else's transaction. You have to stop being the easy liquidity. You have to stop being the crowd. And that starts with one decision. You decide to become disciplined. You decide to become patient. You decide to stop chasing. You decide to stop being predictable. You decide to stop trading for dopamine and start trading for consistency. If this video gave you clarity, like the video because it means you're ready to start seeing the market for what it is, not what you want it to be. Subscribe because Traders Mind TV is about building traders who think like professionals, not gamblers who can draw lines. Share this with someone who needs to hear it, because most traders stay stuck simply because nobody ever explained the real game. And if you're watching this right now and you want to commit to becoming that disciplined trader, comment, "I will stop being liquidity." Comment it so you remember that line the next time you feel the urge to chase a candle. Because once you stop being predictable, the market stops feeling like it's attacking you. And that's when you finally start winning.